Welcome to Iron Financial, the show where we forge stronger portfolios by putting the market's biggest names under a structural stress test. All right, today, CoreWeave is in the crucible. Their latest earnings report just dropped, and honestly, it presents a massive paradox. You've got this record-shattering growth on one side, but a foundation that is absolutely hemorrhaging cash on the other. This demands a full structural analysis. We really need to figure out if this so-called AI titan is built from solid bedrock, or if it's just a house of cards, waiting for the slightest breeze to knock it all down.
Well, let's just start with that breeze, shall we? Because this is what happened the second the numbers hit the wire. This is the market's immediate, brutal gut reaction after hours, a nearly 12% plunge. I mean, after all that hype, all the talk about being the essential cloud for AI, this is the result. The moment they have to actually open their books for inspection, the market doesn't walk, it sprints for the exit. So my question is pretty simple. How is it possible that a company supposedly building the future of all technology sees its stock price just crumble like cheap concrete?
And that, right there, is the exact question we're here to break down today. This isn't about hype, it's about structural integrity. So here's our blueprint for this explainer. First, we'll dive right into the paradox of those earnings numbers. Then we'll build the bull case, what the optimists are seeing. And after that, we're going to grab our hard hats and inspect for any cracks in the foundation. From there, we follow the money, which is always revealing. Then we'll look at the disconnect between Wall Street analysts and the actual market. And finally, we deliver the iron financial verdict. Let's get to work.
Okay, let's get right to the heart of the conflict here, because this is really what it's all about. On the surface, you see these huge, shiny numbers, the kind of stuff that's supposed to make you feel really confident in a company. But the thing is, if you look just one single line item deeper, the entire story completely flips on its head. And this isn't just a minor miss. No, this is a fundamental contradiction in the narrative they're trying to sell.
Exactly. Let's look at the raw data right here. On the left side, you've got the headline that every bull was hoping for. Q4 revenue coming in hot at $1.57 billion. A solid beat against expectations. And that, right there, tells the story of explosive, insatiable demand for AI compute power. But, the market isn't a one-trick pony. It always looks at the whole picture. And wow, is the whole picture ugly. On the right, you see the number that actually determines a company's health. The bottom line. Earnings per share was a loss of 89 cents. Now, analysts were already expecting them to lose money, but this was way worse than anticipated. This isn't just about missing a target. This shows that for every single new dollar they're bringing in through their front door, their costs are spiraling out of control even faster. That is a massive, flashing red flag about the actual viability of their entire business model. You know the saying, revenue is vanity, profit is sanity. And right now, this looks completely insane.
Okay, let's just table that concern for a moment and really commit to building the bull case, because you simply cannot ignore the sheer scale of what they are trying to construct here. The bull argument isn't about profitability in one single quarter. No, it's about building an absolute empire. It's about laying a foundation so vast, so critical to this AI revolution, that any short-term losses are just, the cost of construction for what could be a future monopoly. This is the architectural blueprint for an AI behemoth.
And that blueprint, it starts right here. The sheer velocity of this growth is what is truly staggering. I mean, forget quarter over quarter for a second. Just look at the annual leap you see on this chart. We're going from $1.9 billion in 2024 all the way to over $5.1 billion in 2025. That's a 168% increase, year over year. This isn't just growth, it's hypergrowth. This is the sound of the market screaming for what CoreWeave sells. And that is the first massive, solid pillar of the bull case, relentless, undeniable demand that's materializing into billions and billions of dollars. But here, this is the steel framework that supports that entire structure. $66.8 billion, and that's in contracted revenue backlog. This isn't some wishful thinking or a sales forecast from a PowerPoint deck. No, these are signed deals. This is committed future revenue, locked in. For the bulls, this one number de-risks the entire operation. It provides incredible forward visibility, and it justifies the massive, eye-watering spending that we're about to talk about. The argument is that the company isn't just burning money. It's investing capital to service contracts that are already on the books. And here you have the architect himself, CEO Michael Intrator, putting the capstone on the whole argument. Listen to what he's saying. He's not just talking about being big, he's talking about being the fastest. This quote is designed to tell investors one thing, and one thing only. We are the essential platform. We are moving at an absolutely historic pace, and this is a once-in-a-generation land grab for the foundational infrastructure of AI.
He's framing the company not just as a builder, but as a pioneer conquering new territory. And this slide really illustrates that they're not just selling to anyone. They are winning the foundational clients. I mean, just look at these names. Midjourney, Runway, CrowdStrike, Mercado Libre. These aren't just any companies. These are the pioneers, the next generation of AI leaders who are building their entire businesses on top of CoreWeave's infrastructure. So the bull case is simple. By securing these clients right now, CoreWeave is embedding itself into the very DNA of the AI economy. They aren't just renting out servers. They are building the very bedrock for the future.
Okay, that's a beautiful story, a really nice architectural rendering, but we're not here to look at drawings. We are here to inspect the construction site. And when you actually get your hands dirty and look at the real financials, you don't see a solid foundation. You see a structure that is under immense, and I mean potentially catastrophic financial stress. So it's time to find the cracks.
And the very first crack we find is a canyon. Just take a look at the comparison on this slide. In Q4 2024, they posted a net loss, and that's their loss according to the official GAAP accounting rules, of $51 million. Okay, now fast forward 1 year. Yeah, revenue has exploded, sure, but their net loss has ballooned almost 9 times over to $452 million, and the margin has deteriorated to a staggering negative 29%. This suggests that their core costs, which are likely for those super expensive GPUs and the massive energy bills to run them, are growing even faster than their impressive revenue. They are literally losing more money for every dollar they bring in. That is not a scaling business. That's a hemorrhaging business.
You know, if that net loss was a crack, then this number is a sinkhole that is swallowing the entire construction site. Negative $8 billion in free cash flow over just the last 12 months. Now, free cash flow is simple. It's the actual cash a company has left over after paying for all its operations and its big capital investments. But in this case, it's not what's left over. It's what's been completely incinerated. That $66 billion backlog is nice to look at, but it doesn't pay today's bills. This isn't just investing for growth. This is a 5-alarm fire in the company's treasury.
And let's just zoom out to the full year, just to make sure this isn't some one-quarter anomaly. It's not. As this chart clearly shows, the problem is actually getting worse. In fiscal year 2024, the company lost $863 million. In 2025, a year of supposed historic success, that loss widened to almost $1.2 billion. The bull case says they're doing some heavy lifting to build an empire. Well, this chart says that for every shovel of dirt they move, the hole just gets deeper. So the critical question becomes, are they actually building up, or are they just digging their own grave? So now let's move on to what I personally consider the most damning piece of evidence of all. Forget the balance sheet for just a second. Let's look at the actions of the people who know this company better than anyone. We're talking about the architects, the engineers, the executives. Are they doubling down on their creation, or are they quietly heading for the exits with bags of cash? Because what they do, not what they say, should be a massive red flag for any investor looking at this structure. Just take a look at this number, 2,310. That is the number of times an insider at CoreWeave has sold stock on the open market in just the last 6 months. Not 1, not 10, not even 100. Over 2,000 separate sale transactions. This isn't a trickle, it's a torrent, it's an exodus.
And the contrast on this next slide is what's truly, truly revealing. How many times did an insider buy shares in that same 6-month period? How many times did one of the people building this supposed empire decide to put more of their own skin in the game? 0. Just let that number sink in. 2,310 sales, 0 buys. If the people on the inside truly believed in the long-term strength and integrity of the structure, there is no way this number would be 0, period.
And we're not talking about low-level employees selling a few shares to buy a car. Just look at the names and the sheer scale of the money leaving the table. Magnetar Financial, a major filer, cashed out almost $3.5 billion. The chief development officer, almost $500 million. The chief strategy officer, $380 million. And the CEO himself, Michael Intrator, the man giving those bullish quotes, he's sold over $128 million worth of his own stock. Now, they'll tell you it's for tax purposes or for financial planning, but at this scale, across the entire C-suite, it's often a signal that those post-IPO lockup periods are ending and they want to diversify because so much of their wealth is tied up in one risky asset. It looks less like planning and a lot more like bailing. And it's not just the insiders either. There's a major split happening in the institutional big money world. On one hand, you've got these behemoths like FMR, Proficio, and Cotu dumping their positions. As you can see, Cotu and Proficio sold everything, a 100% exit.
That is a massive vote of no confidence. But at the exact same time, you have Vanguard coming in and building a brand new position worth almost $1.5 billion. This shows an extreme division of opinion among the world's supposedly smartest investors. Some are running from the fire, while another is running right toward it.
And all of this brings us to one of the most interesting parts of this entire puzzle. This massive disconnect between the professional analysts who cover the stock for a living and the immediate, almost visceral reaction of traders and investors, what we call the street. The two groups are telling completely different stories about the exact same set of facts.
Look, on the left, you have Wall Street. 11 analysts with buy ratings, 0 with sell ratings. They are hearing that bull case loud and clear. They see the $66 billion backlog, they see the hypergrowth, and they believe the long-term structural story is totally intact. They seem perfectly willing to look past the insane cash burn and the insider selling. But then, on the right, you have reality. You have the market's reaction, an immediate nearly 12% haircut. The street, you see, doesn't care about a 5-year plan when the house is on fire today. They see the widening losses, they see the executives cashing out, and they're voting with their money, plain and simple. So the real question is, who's right? Are the analysts seeing some long-term blueprint that the rest of us are missing? Or is the market correctly identifying an immediate and very real structural danger?
All right, we've laid out the blueprints, we have inspected the foundation, and we've listened to all the conflicting reports. Now it is time for the final verdict. We need to weigh all this evidence, cut through the noise, and determine if CoreWeave is a generational opportunity to invest in the future of AI, or if it's really just a value trap that's been built on a mountain of hype and debt. It's time to separate the bedrock from the rubble.
So let's put it all on the scales one last time. The bull case, the bedrock, is really built on 4 solid pillars. Historic hypergrowth, that massive and de-risking $66.8 billion revenue backlog, what appears to be a dominant position in the AI infrastructure market, and of course, unanimous support from Wall Street analysts. But the bear case, the rubble, is equally, if not more compelling, and it's founded on undeniable facts. You have GAAP losses that aren't just big, they're getting wider. You have a torrential cash burn of over $8 billion that is simply not sustainable. You have unanimous and heavy insider selling from the very top, and you have major institutional investors running for the exits. So here is the iron financial verdict. CoreWeave is not a house of cards, but it is one of the most leveraged, high-stakes construction projects in the market today. The foundation is being poured with borrowed money and is, right now, deeply unprofitable. The bulls are betting that the skyscraper they're building will one day be so valuable that these massive foundational costs will just be a footnote in history. And the bears are betting that they'll run out of cash and credit long before they ever get past the first few floors. For us, the unanimous insider selling is the most significant structural flaw we see. The architects themselves are selling their shares in the project. Our verdict is this: CoreWeave is a binary bet on execution. If they can somehow convert that massive backlog into profitable cash flow before their funding runs dry, it could absolutely be a titan. But the financial stress is immense, and the actions of the insiders suggest they lack conviction in their own blueprint. This is a high-wire act with no safety net. Moving forward, investors should be watching 2 things like a hawk. First, any sign of improving profitability or gross margins in their next quarterly report, and second, a significant slowdown in that cash burn. Those will be the key indicators of whether this skyscraper is going to reach the clouds or come crashing down. Which leaves us with a final question for every single investor to ask themselves. Is all this heavy lifting actually building an empire, or is it just digging a grave?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.